Hi, this is Dan Harding. I'm the founder of Wealth Prime. I wanted to quickly show you this new tool called Insurer Plus, where we're taking a 38-year-old doctor, business owner living in Oregon who's making $600,000 a year, and we're showing the strategy on how to set that client up for $100,000 or more in tax savings and an after-tax income of over $400,000 per year for 15 years. The way we do that is advanced retirement plan designs inclusive of life insurance. So let me show you how this all works. On the left-hand side, we have a traditional retirement plan, 401k, profit sharing, and cash balance defined benefit plan, where we're not purchasing any life insurance. Therefore, we have also a zero death benefit. We know that the client is going to be able to get around $400,000 or just about $400,000 a year after tax per year, 15 years. And after they've basically funded out all of that retirement asset, they're going to have $13,000 left in their account at age 86 versus putting together a more advanced plan design, which is a cash balance defined benefit plan where we're funding $188,000, $178,000 into the plan annually. But we're actually going to purchase life insurance as an asset class inside the plan. So tax deductible life insurance, $75,000 per year for 5 years. It's going to give us a death benefit of just over $1.7 million. Now we're still going to have the same $408,000 after tax income from 71 to 85. So we're in a fair comparative analysis to the other design. But check this out. We're going to have over $6 million left in our retirement plan at age 86 versus $13,000. So let me show you how all of this works. As you can see here, we're in the funding and premium phase of the strategy, where on the left-hand side, we're putting $216,000 in annually, which is going to give us, in our tax bracket, I think 41%, a total tax savings of $108,000. After 5 years of growth, assuming a 6% rate of return, we're going to have $1.3 million in our retirement plan with no life insurance. Now, if we bifurcate the assets and are using $75,000 of the 216 to fund life insurance, means we're going to have a smaller amount of money going into the traditional retirement asset. We are somewhat underfunded in that what's called cash balance defined benefit plan, and we're allowed to make up for it with a much larger contribution in the 6th year, which also then allows us to buy out the life insurance. So let me see that again. We're putting an additional retirement plan contribution in, an after-tax contribution in, which gives us a larger amount into the retirement plan than we would have if we didn't make that, obviously. But the biggest thing is now we're buying out the life insurance policy, which will be used down the road for a combination of death benefit if we do happen to pass, but most importantly, tax-free income. So let me show you how powerful that $75,000 per year after-tax income is going to look down the road. We get to the distribution phase. Now, over on the left-hand side, we have $7 million in retirement assets. And on the right, we've got 6.6. To get to the $408,000 net after-tax income the client needs to survive with their retirement and their second home or what have you, the client needs to pull out $680,000 distribution per year, tax at 40%, which gives a $408,000 after-tax net income. As you can see, the amount that we're pulling out each year at 640 is reducing the total retirement asset down and down and down until at age 86 they've got $13,000 left in this account. Now, on the right-hand side, remember we had this after-tax income, the tax-free distribution from the life insurance that we used the $380,000 to buy out. Now we've got this large $173,000 after-tax payment, which means to get to the same $408,000 after-tax annually, we need to pull out only $390,000, which gives us after the 40% distribution tax, $234,000, which plus $131 173 gives us our 408. So by bifurcating the asset classes and by taking a somewhat circuitous route, we now have a hedge against depleting all of our assets faster. As you can see, since we're only taking $390,000 out of the policy, the amount is going down absolutely, but it's also continuing to increase because we still have that 6% rate of return. So with compounding interest, a large asset is going to continue to grow versus a small asset. Now, we do have the tax-free death benefit. We do have the $6.2 million in the account. And we do have either way, we've got this income of after tax of 400,000+ per year. So let me break this down one more time. This is the comparative analysis between no life insurance and life insurance and the additional costs and benefits of that. Regardless of which plan design you or your clients decide, you're going to have, based on this age of this individual doctor, you're going to have around $216,000 annualized contribution for 5 years. Now remember, with the life insurance, you're breaking into two different parts: life insurance at 75 and traditional assets at like 130. And then in year 6, when you have the life insurance, you got to fund more into the plan to buy out the life insurance. That's an additional $380,000. So the difference is, without the life insurance, $1 million total costs. With the life insurance, 1.4 and change in total costs. Regardless of which plan design your clients decide to go through, they're going to get a tax-free income of $6.1 million over 15 years. And then at age 86, without the life insurance, they're going to have $13,000, and with the life insurance, they're going to have $6.2. So for this $380,000 cost, it's basically a $5.9 million overall difference in net. Here's the illustration one more time. Visualize it: total costs, amount of tax-free income, and then the value at age 86. You get $13,000. You can't even see it. It's so small. Then we click the download the illustration to quickly show how the plan is actually designed. $75,000 in income for 5 years, $375,000. A death benefit at that time of $1.7 million. As you can see, it goes down the road. The buyout, remember, we need to buy out the life insurance from the retirement plan of $380,000, and then the tax-free distribution starting at 71, going to 85 of 173. So Ameritas is the company that we're using for this illustration, and they have great opportunities inside these plans. So net, if you want to have a client that wants to save over $100,000 a year, have a large retirement plan asset inclusive of after-tax income and a death benefit, then the Wealth Prime software is the one for you.